As a consumer, you must understand that compound interest is good under one condition, only when you are earning it. That's it. If you're getting paid compound interest, then you are in good hands. If you are paying compound interest, you are in a big trouble. If you want to master personal finance, I think there is a list of financial terms that you must understand inside out to avoid financial pitfalls and take advantage of different financial products available to you. In this video, I will go over the top 5 personal finance terms you must understand to be able to make better financial choices and avoid common financial traps. The reason I say this is because millions of people right now, they are struggling financially. People can't save money, people are struggling with debt, and people don't understand the best way to save money. Even the people who are making enough money, they don't know how to save it. Now, everybody knows about saving, but when it comes to actual saving, people can't. That is why, starting from today, I want you to understand how these top 5 financial terms affect your financial situations and how you can move forward after learning these 5. Now, the first term we're going to start with is asset. By default, asset means anything of value that you own. Because of this definition, people think that if they buy clothes, that is an asset. Why? Because it has a value and they can resell it for some money. That is true at some extent, but if you want to take control of your finances and build wealth and one day become a millionaire, like so many people dream of, you have to redefine the term asset. Once you redefine asset and you try to live by that new definition, then you are going to avoid a lot of financial mistakes a lot of people are making out there. Instead of saying that an asset is anything of value that you own, let's take it one step further. An asset is anything of value that you own, but it has to earn you money. Now, if you define it that way, you are going to realize that your clothes are not an asset. Why? Because they cost you money and their value goes to zero over time. So eventually, the clothes you have in your closet, you will throw them away. Let's go to the most controversial examples. Most people buy cars, multiple cars by the way, because they think that cars are assets. I hate to tell you this, your car is not an asset. And why is that? Even if it is paid off 100%, it is not an asset. Again, you have to define asset as anything you own that makes you money, that puts money into your pocket. Now, does your car makes you money or it takes money out of your pocket? Let's see that. Let's say you go to the bank, you borrow $50,000 and you went to your favorite dealership and purchased your dream car. After buying that car, you're gonna have to pay the registration fees and so many other fees that come with the car purchase. And then you're gonna have to pay excessive insurance, a very expensive insurance, because in this case, you must have a full coverage for a car of that value. And then on the top of that, you will pay interest on the money you borrowed. You also have to consider the gas and regular maintenance and all of that. That's the cost of the car, but that's not it yet. Because the biggest expense, what makes car liabilities, is that the value of your car goes to zero over time. Yes, you purchased the car for $50,000, but guess how much it's going to be worth 5 years later? Your car is going to be worth about 50% of what you paid for. So if you paid 50 grand, 5 to 6 years later, your car will be worth 25 or less sometimes. So not only that you're paying excessive insurance, a lot of routine maintenance, registration fees, and the gas and so many other stuff, and interest on the money you borrowed, the value of your car goes to zero over time. Based on the new definition of asset, your car is not making you money. Instead, it is costing you money. I consider a car as a depreciating liability. The reason I say that is because the value of the car goes to zero, hence depreciation, and it is a liability because it's costing me money. If you use this new definition, you are not going to accumulate so many cars because cars cost you money and therefore it is a liability. And in personal finance, to master your personal finance and to build wealth, you have to accumulate more assets and stay away from liability. So that means your car is not an asset, Some of your homes are not assets. Your boat is not an asset. And so many other little things you buy, like your lawnmower. Some people buy like multiple lawnmowers saying that these are assets. No, these are not assets. These are liabilities. They're costing you money over time and their values are going to zero. From now on, when you think about asset, start thinking in terms of value and return on investment. This product you buy, how much is it going to make you every month, every year, every 6 months? If it is going to cost you money, it is a liability, whether you paid it off with cash or not. The second term is liability. So now you know what an asset is. What is a liability? A liability is something that costs you money, something that takes money out of your pocket every month. Asset and liability, they go hand in hand. So a lot of consumers buy a lot of liabilities thinking they are assets, but eventually that's what drives them to more debt and more financial trouble and more hardship. Anything that costs you money is a liability. Your car is a liability. We just talked about it. Your boat is a liability. Your lawnmower is a liability. Clothes, your shoes, your jewelries, all of these are liabilities. Why? Because they don't earn you any money. By understanding the difference between asset and liability and using the redefined terms, you will be able to understand what should you buy many of and what should you stay away from. The key is to buy more assets and avoid liabilities. Now, the third term I want you to understand, which is very important, this is one of the most important financial terms every person should understand, and how this term can help them redefine and improve and take control of their finances and build wealth. It's called compounding interest. There are two types of interest: simple interest and compound interest. So simple interest means you pay interest only on the original principal amount. If you owe the bank $200, you will always pay interest on that $200. What is compound interest? So compound interest is a different type of interest that some loans come with. As a consumer, you must understand that compound interest is good under one condition: only when you are earning it. That's it. If you're getting paid compound interest, then you are in good hands. If you are paying compound interest, you are in a big trouble. This is how compound interest works. Every time you pay interest, the interest is added to the principal, and then the new interest is recalculated based on the new principal amount. Over time, your debt grows exponentially because your principal is growing exponentially. You must understand the compound interest and avoid paying compound interest, because your debt will get bigger and bigger and bigger and bigger until you can no longer afford to pay it off. That's how you end up on the streets. The fourth most important personal finance term you must know by heart is tax. Okay, so now tax, everybody knows about tax, right? But as a person who wants to grow wealth and become financially independent, so you need to understand what taxes are and how you can take advantage of tax. So tax is, what is it? Tax is pretty much a portion of your income you pay to the government to help take care of the government. Pretty much that's what it is. The reason I included tax in this list is because tax is the biggest expense on your income. And this is because when you make money, you pay tax. You pay your federal income tax and your state income tax, right? But then what you take home, that's what we call your net income, after all other deductions are taken off, right? That's your net income. It should be yours and nobody should take any claim on it. But guess what? When you go shopping, you will pay tax. So that means you pay tax when you earn money and you pay tax when you spend that money. Even if you use the money to buy a house, you will always pay tax on the money you paid the tax on already. So that is your income gets taxed when you earn it, when you spend it, and even after paying all those taxes, you keep paying tax on it. That's why as a consumer, you must understand how to take advantage of different tax benefits to minimize the amount of tax you pay. Let me tell you why lowering your tax is one of the most important steps to help you build wealth fast. Right now, the middle class pays the highest tax. Even if rich people make more money, they pay the least amount of tax. Middle class and the poor people, they pay the most tax because they don't understand how tax works. In general, tax is applied to the money you earned. For example, if I go to work and I get paid $1,000, then that is an income. Because of that, I will pay an income tax based on my tax bracket. But what if I went to work and you get paid $1,000, and instead of taking that $1,000 as income and then let it go into my pre-tax 401k, guess what? I won't pay tax on that money. Why? Because that $1,000, even if I earned it, is not realized. I want you to understand this thing. There is a term called realized income and unrealized income. Every realized income is taxable. Unrealized income is not taxable. So your goal is to realize less income to lower your taxes. That's how you take advantage of tax benefits. Of course, you can take advantage of other tax credits, but you must understand the benefits of not realizing a lot of income. The only way to lower your taxable income is to realize less income. That's how it works. The reason most people pay the most tax is because they realize every penny they make. If you realize every penny you make, then every penny you make is gonna be taxable. And that's how you end up paying the most tax compared to the rich people. Rich people don't realize a lot of money. They let their money grow without even realizing it in the background. And if their money is not realized, they won't get taxed. What leads people to realize all their incomes? That is because they are living above their means. People have expensive lifestyle to a level where they need every penny they make to sustain those lifestyle. If you spend it too much, that means you need to earn more to be able to buy all those crap you don't need. If you have a lot of car loans, you have a mortgage, you have student loans, all these personal loans and credit card debt, that means we need to realize every penny you make to be able to pay off all those bills. But realizing every penny again means you will pay the most tax. That's why the fundamental step to lowering your taxable income is to understand that living below your means is the foundation of every financial success. You have to be okay with less. That's how it works. And then if you don't have all those debts, you don't have all these credit cards, that means you can afford to keep your money away and let it grow without realizing it. Now, this is one simple strategy you can use. So the most and easiest way to realize less income is to contribute to your retirement savings. Start with a 401k. With pre-tax 401k, you can contribute up to $23,000 for this year, for 2024. That means if you made $50,000 and maxed out your pre-tax 401k, only 27 grand will be taxable. Instead of paying tax on 50 grand, you will pay tax on 27 grand. That's how you put yourself into a lower tax bracket. Another strategy, contribute to your IRA. If you have a pre-tax 401k, I recommend having a Roth IRA. Simply because there's so many benefits and give and take. The second strategy you can use to lower your taxable income is to contribute into your traditional IRA. For 2024, you can contribute up to $7,000 if you are under 50 or $8,000 if you are 50 or above. If you were left with 27 grand and you contributed $7,000 to your traditional IRA, guess what? Now you have only $20,000 left. Now, instead of paying tax on 50 grand, you are going to pay tax on 20 grand. Now you can see how much you can lower your tax right now. Like literally by living below your means, you can be able to let your money grow without touching it, without realizing it, which allows you to grow it and lower your current tax liability. And of course you pay tax later during retirement, but tax is not a problem once you have become rich. But paying too much tax before you become rich is the foundation of all financial struggles. And then if you want to take it to the next level, you can open a health savings account. And the money you put into a health savings account is not taxable. That's how you lower your tax. That's how you take advantage of the tax. And then when you're filing your taxes, you can take advantage of other tax benefits you qualify for. And then a combination of all of this can help you lower your taxes. And if you have extra money to invest, try to invest in long-term investments. Don't buy short-term investment. Buy long-term investments, because when you have a long-term investments, you pay a passive income tax, which is much lower compared to your income tax. The last term we're going to talk about is a term called investing. Now, you heard about this term before, and you more likely know a lot about this term, but I want you to understand that a lot of people misunderstand what this term means. What is investing? Sure, you go out there, you buy your phone, and you call that an investment. That is not an investment. A lot of people are doing that. People are buying cars and calling that an investment. That is not an investment. People are buying like video games and random stuff like clothes and shoes and lawnmowers and just random stuff, and they're calling those investments. That's not investing. The term investing simply means you buy an asset, hold it for a little longer, and sell it into the future with expectations of return at the same time while protecting your initial investment. That's what investing means. Now, investing don't yield a positive return all the time, but the expectation is that you will make a profit. So that means whatever you buy, it is an investment only if it has a probability of earning you a return. If it's not going to earn you a return, then it is not an investment. You are just gambling or speculating, but understand that investments should always yield a return, a positive return, because you can have also a negative return, which is something else. But the goal is to earn a positive return. The reason I put down investing as one of the top 5 financial terms you must understand is because investing is the foundation, is the easiest way to build wealth. Simply because you can earn money, put it into different assets across multiple sectors, and watch your money grow over time. These are the top 5 financial terms every person should know. Now, these are not the only ones, by the way. There are more and more terms you should know, but these are the most important 5 to start with. Here's a recap of what we talked about. First, understand the difference between asset and liability. Your goal to build wealth, you need to buy more assets and stay away from liabilities. Asset is anything that earns you money. Liability is anything that costs you money. Number 3, you need to understand the importance of compounding interest and why you should never, ever allow yourself to pay compounding interest. Compounding interest grows your debt over time if you don't take action. That's why you should never carry a balance on your credit card, and you should always stay away from debt with compounding interest. Number 4, tax. Tax is the biggest expense on your income, and as a consumer, you should always try to minimize your taxable income. Tax is going to be your biggest enemy if you don't do your math correctly. And number 5, we talked about investing. Investing is the easiest way to grow wealth, simply because you can put your money into a specific asset and you watch your money grow over time without even lifting a finger. And that's how you make your money work for you. If you like this video and you want more content like this one, subscribe to my channel and visit my website. Oh, of course, like I said, I put together a list of 243 most used personal finance terms every person should know. So if you want the rest of the list, please visit my website.